that the central bank itself has set an inflation target of between 6 and 9%. Between 6 and 9%. And because we are still above that threshold, we will only cautiously either do some true signaling.
The governor of the central bank, Godwin Emefiele, explaining some of the presentations he made earlier in a question and answer session with the media corps who are there at the headquarters of the central bank in Abuja. Thank you, everyone, for standing by with this live transmission. Of course, the presentation of the communique by the governor started a little bit earlier than usual, but our panelists here will be wrapping this up for the next 30 minutes. Robert Tomotude, who is the head of research at Afrinvest. Thank you so much, Robert, for being here. Kemi Akinde, who is the head of investment research at Meristem Securities. Thank you very much. And Wahab Mustafa from Kodos Capital, in charge of monetary, macroeconomy and investment analysis. Thank you, gentlemen. Let's take a round very quickly on what the governor says. The communique was pretty straight and simple, but now it's providing what you call facts behind the figures to some of this, what has been said. Mustafa, let's start with you. What's your take on this hold decision?
Yeah, I mean...
In line with your expectation?
In line with expectation, yes. So, obviously what I heard from the governor is that, I mean, of all of the factors competing for attention, growth seems to have taken, the center stage. I mean, it does make sense because when you compare GDP in Q1 versus where we're coming from pre-recession, what you see is that we are still, way below historical levels. So, I mean, the concern for us that the CBN actually highlighted is the fact that, liquidity in the system might be some sort of an issue. I mean, by our estimates, at the tail end of the year in Q4, we're expecting about 4.1 trillion, to hit the system. And obviously, the CBN would have to worry about, the impact of that on, obviously, currency as well as, price level. I mean, it does make sense to leave rates steady at this level to ensure that they are able to manage that space.
Okay, Akinde, what's your takeaway from this communique at the end of this meeting? Is it de-risking the financial markets? Is it about the FX restrictions on milk? What is it in this MPC for you?
Okay, the decision was very much in line with our expectations of a hold. We can see that the committee is quite big on growth, but there are concerns around two major things as well, which is the kind of like an asymmetric response of lending rates, to the MPR. So it's kind of sticky downwards, but it's sticky upwards. And the second concern is around the yield environment. So it also has a weak correlation. So when they reduce MPR, the yield doesn't reduce to the extent that it motivates banks to reduce exposure to risk-free instruments and then grow credit to the real sector. So it kind of put Nigeria in a situation where you can maybe describe it as like what happened in the developed countries, the zero lower bound, i.e. growth becomes increasingly insensitive to further reductions in MPR. And that's been the situation. So it then makes the CBN to look at like unconventional monetary policy, too. So you see the central bank itself, doing kind of direct intervention in agriculture, in SMEs, in creative industry, in textile, and all that. And coupled with the recent regulation to the banks as well. So now the question is, there is that weak correlation, but they should also be able to say, what, as a monetary policy committee, we can actually say monetary policy is driving growth. But if you're adjusting rates and you're not seeing the growth, it then begins to look at other options, and that's what we're saying. So the recommendation from the last meeting is look for a way to ensure banks, grow their risk assets, SMEs, mortgage. Look for a way to actually debar them. It was put in the last communique from, maybe assessing the government securities directly, which is what they've actually done. So our concern is, what? There is that weak correlation, but they need to be able to establish that there is that correlation. Otherwise, you talk about the mandate of the Monetary Policy Committee. So going forward, what we're going to be seeing is going to be more like there will be a rate cut, but it's going to be followed by certain other measures to boost credit because the lending channel is kind of weak. And we have some issues regarding that method. Okay. Now, first thing, they talk about growing credit to the SMEs, growing to mortgage. Mortgage institutions are licensed and supervised by the central bank. And these are the best channel to develop the mortgage sector of the economy, not commercial banks. Microfinance institutions can strongly support SME lending, consumer lending. Finance houses are equally licensed and supervised by the central bank. They can play their role within that growth space. So we have specialized institutions that can actually fulfill that mandate, but they are all being lumped together and dumped on the banks. So there should be a kind of balance, within that space. Now, the other thing is exuberant credit growth is almost always everywhere a recipe for financial instability. Take a look back, even over the last 5 decades thereabouts, all the major financial crises have been preceded by that. And what we're seeing is a kind of ambitious growth, for credit by the banks. And it's coming in an era where we still have slightly elevated credit risk. We have, high NPLs. Yes, it's trending down, but it's still above the prudential guidelines. We're also seeing increased, build-up of household leverage in Nigeria. And if you look at the financial crisis, you see things, no income, no job, come get loans. Those are jumbo loans. You're seeing all those kind of things play out again. No collateral, no guarantor, no this, come get loans. So within that environment, aggressive credit growth can actually have some unintended repercussions. So when you talk about the issue of the financial environment and things like that, I think that's one thing that that MPC should actually watch.
We need to watch, perhaps not the MPC, but the central bank itself, which is in charge of monetary. The MPC are just members who make comments and give advice and what have you to the central bank. And,
sure.
and Robert, if you take everything that Kemi has said on board, and we say, so how do we need to grow credit? And as the central bank chief says, look, the banks were primarily licensed to do that financial intermediation. We can't push it to anyone else. But you rightly put it, finance houses, primary mortgage banks, the PMIs, and microfinance, MFBs are also all licensed and regulated by the central bank. So it looks like, well, we have more than commercial banks in terms of financial intermediation. But again, if we stack this up, we know that central bank will always hold the banks responsible first than others who are financial financial institutions within the bracket. They always hold the banks first because they believe the banks have the muzzle, the financial power. They take more deposits than microfinance banks and finance houses. So perhaps if a bank is making 150 billion per year or so, or half year in returns in terms of profit, so the central bank has to say, hey, can we give about 50 of that out? Not just giving everything to shareholders at the end of the day. I'm sure you folks are interested in what the dividend is. Robert.
So I think I align with most of what Kemi mentioned, in that there are specialized financial institutions, that should tackle some of these areas that the central bank is delving into. That's not to say that it's not laudable what the central bank is trying to do. And maybe it's more pronounced now because we are in an environment where we have weak growth, in terms of the momentum. But again, this has always been the call of central banks from different tenor of different central bank governors that we've had. In the time of Soludo, it was always also the cry that we need to grow credit to the private sector. But maybe we should take a pause and just look at some other areas that we need to look into. Why are the banks not creating this credit? In the real sense of it, as it stands today, based on the yield environment, even if you're taking the prime lending rate, at least based on the data that is supplied by the central bank, you still earn a higher yield, or let's say you charge the higher interest rate, when you're creating credit. It comes with a higher risk, and of course, it should come with a higher rate. So in an environment where rates are dropping, you would expect that naturally banks will begin to look at, niche opportunities into sectors they can lend into, to get the higher income. But a little bit of what Kemi said, will come into play. Why? The banks are not doing this because of the risk in the system. So there's a need to de-risk the system. Maybe this is where the fiscal authority needs to come in. Central bank is doing its bit, but the banks naturally will take opportunities that exist, when they know that the risk, they would normally take a calculated risk.
Mm-hmm.
So this is a long-term thing.
Mm-hmm.
It's not something that will have immediate impact, de-risking the entire.
So if we want to de-risk the market, we are technically de-risking the economy.
Exactly.
Mustafa, here, you do a bit of macroeconomy at Kodos Capital. So if you want banks to lend to the real sector, the real sector is not formed by the central bank. It's a function of the fiscal authorities, that is the government. So if the If that sector, those sectors are not doing well, in the manner of speaking, we need to ask the fiscal authorities, what are you doing? So the MPC continued to re-emphasize infrastructure, power, and we started this conversation about the New Deal with the Germans and Siemens in terms of the electricity. Do you think there's a lot more here that the fiscal authorities need to do to meet the central bank halfway?
Obviously, yes. I mean, the key reasons why you see, the central bank and monetary policy committee, hammering on the need to grow, the macroeconomic environment is the fact that we've not seen a lot of activities coming from the fiscal side. And that's because, I quite understand because, revenues for the federal government has actually been starkly, disappointing when you compare it to the budget. I think that's one of the key reasons that make them, incapacitated. Obviously, we would like to see more from that end. And again, now that we're seeing, crude oil price remaining largely stable, we should expect to see, continued rising fiscal spending from the fiscal side. So the impact of that should obviously, boost economic growth from that end. But now that we've not started to see anything from the fiscal side policy end, we should expect, monetary policy to continue to, put policies in place that would ensure that, we move from this tepid growth level to, the pre-recession historical levels.
It's quite some time, Kevin, that we saw all members vote in the same direction. This is quite surprising. 11-11, isn't it?
Yeah, it is.
So do you think there's a compelling argument or compelling reasoning here among the 11 members to say, look, let's vote in the same direction, no dissenting voice. Of course, nobody wants a tightening. But again, no one voted also for easing.
I think it's that was also our own, submission. So you ask, if you losing, what would change? What will happen? So we think it would have been like policy overdose. So the idea behind losing is to grow credit, right? And they've just put policy measures in place. We talk about the LTD, the STR, and the signaling effect at the last OMO auction. So all that was to stimulate credit growth. So it would have been redundant to cut the rate at this moment because it wouldn't do anything. So we talk about that correlation is kind of weak. So the best position was just to hold and then use other unconventional monetary policy measures to actually stimulate
Do you
growth.
think central banks around the world are finding it
effect.
very difficult here to handle both inflation, growth, and interest rates at the same time? Do you think it's becoming increasingly difficult?
Yeah, what we observed in the developed markets is this. So low labor productivity and low labor supply have actually dampened growth outlook. And combined with low inflation, it means rates are going to be lower for longer. So, and for most of them, they run an inflation targeting monetary policy regime, unlike what we operate here. So most of them have the benchmarks at 2%, Canada, Australia, UK, US at 2%. And for most of them, it's actually running below 2%. So I don't think that is a real major problem for them. But the most important thing is how that is going to impact fund flows. So as I mentioned, low growth outlook, lower interest rate for longer, and of course, it's going to most likely increase risk appetite for emerging market debt.
Robert, do you think if the U.S. Fed cut rates this month and perhaps in September, perhaps another one in December or so, do you think this is a signaling will be strong enough for our own MPC to consider what to do over the next balance of about 2 meetings before the end of the year?
Well, I think most likely market expectation is that by the FOMC meeting in July, there will most likely be a rate cut, which is what the market has priced, into some of the assets. You see the rush for emerging market assets that investors have even thrown caution to the wind, and they would rather buy the speculative instruments because there's this craze for higher yields
but it looks
in
like,
other markets.
Yeah, but it looks like investors are sticking between the frontier and the developed markets and sticking with the emerging
absolutely,
markets.
because they have the higher yield.
It's not flowing this way.
Again, because they have the higher yield. So the point is that for our own market, even if that is sustained, again, market in the U.S. market, for example, it's already anticipated that by the time the meeting holds at the end of this month, there will be a further cut in rates. But I do not think that the monetary policy would necessarily shift. Like we say, MPR is not necessarily an anchor right now. The market rates from the OMO rates and treasury bills are giving more of the signal than the MPR is doing. So,
any
objective.
So you think the central bank is saying we're going to hold, we use monetary tools to moderate yield on treasury bills, let the U.S. Fed do the cuts, then the money flows this way. Smart move.
Yeah, and one thing also is with respect to that, so the idea is if they keep dropping, we can as well drop and maintain the differential. But what happens is that interest rate differential from a policy rate perspective, that is not where the money is. The money is in the yield environment. So you're looking at yield differential. So if you look at January 2nd was 2.6% on the yield curve in the US. The 1 year mark was 2.6%. By last week, it was 1.9%, 1.95. In Nigeria, it was 16.79, and by last week, it was 11.8. The yield differential has dropped from 14% in January at the beginning of this year to 9.9%, even though MPR was only cut by 50 basis points. So if you're looking at from the yield perspective, even if they keep dropping rates, we don't need to drop it because yields have already declined in the Nigerian environment.
So let's wrap up this conversation for the next 10 minutes. Mustafa from Others Capital, coming from Meristem Securities, and Robert from AfroInvest. Robert, do you think there's anything you take away from the governor's very elaborate explanation about why the regulator wants to restrict or restricting FX for milk or dairy products? Milk in particular.
Yeah, I mean, I kind of sympathize with the central bank. I mean, on this, remember that since the current governor came on board, he's been very particular about eating what we produce, and that has been the anchor or the objective of most of his policy around FX restriction, right? And I mean, he made some very elaborate explanation about how they started the discussion. That think about, you mentioned something about three years. Yeah, 3 years ago when they engaged with the so-called producers.
So it's been 3 years in conversation.
Was it 2 years? Yeah, 2 years ago when they engaged with the producers of this dairy product, but they've not seen that much of maybe collaboration from them in backward integrating. And from a business perspective, if they consider it cheaper for them to import, right? A businessman will always want to, maximize his profit. So again, this is central bank coming in to say, since I am the major supplier of this FX, I might restrict your access to this FX. It's not been officially banned. Maybe they can extend to going through the fiscal authority to say, can we actually ban the importation of this product? Which is the bit that I feel may be much more effective, because if you restrict FX access, what if they have other sources of, getting their FX? These products will still come in anyways, But again, we need to analyze the full impact that it will have on the current consumption, to the extent that we've not built the capacity to produce, the sort of demand that we can consume. Then we may have to do it in a graduated manner, so that you won't see that shock. The impact on it could be that there won't just the product may not be available, assuming they don't have the other alternatives.
Well, some of the information we have was that one of these milk producing giants already in talk with one state in the northern part of the country, trying to arrange and have a situation in which these cows or cattle are settled in a way that will make them more productive for us. Kemi, what do you think here? Do you think we have a major problem on our hands, which is breeding violence and all of that? If we use a business idea to resolve what you call a violent situation, which is basically the underlying factor is economic here, really, from the way it's explained. If cows are not breeding, cows need to eat. And if I own cows, I will have to find food for them. Where do I find them with climate change and other things? So I need to move. But cows do not discriminate between cassava that is planted and any wild leaves. It leaves its leaves to a cow, isn't it? So it doesn't discriminate. So if you're a farmer and I own cows, we're both in businesses, isn't it? Mm-hmm. So we both need to protect what we invested in. So we need solution to that?
Yeah, definitely. If you look at the bigger picture, yes, profit margin may actually shrink for them if they decide to backward integrate. But looking at the bigger picture, the resolution of social issues around the herdsmen farmer prices, I think it will be, a very major, thing to achieve. So I think it is a step in the right direction. At least they started engagement with the state government, and I think they should actually, gain traction along that line, even solving the insecurity issues around that, using that to solve the insecurity issues. I think it's going to be a laudable achievement.
We have a huge population here, and our population birth rate is very high. Most of us, so even the price of milk is still considered a little bit high. A tin of milk, for example, if you're using powdered milk, it's still expensive. So if these companies do backward integration, perhaps we'll get down to a point in which price of milk go down, and they can leverage volume or turnover for profit, which they're milking from all of us right now.
Yeah, definitely. I think if you sort of remove the impact of FX from importing, right, that might significantly bring down cost of producing, cost of importing, right, which ultimately will filter into the cost that the price that they will charge eventually. If you check industries such as cement, one of the key reasons why it's very profitable and it's not too priced is because the producer actually owns the entire value chain, right? So as at the beginning, right, if you stop them from importing that kind of product, at first it could hurt profitability for them. But as time goes on, when they are done, doing all of the backward integration, that could potentially bring down costs for them.
Hold on a second.
Yeah.
A milk company could actually own cows.
Yes, they could.
Sure.
They could.
Yeah, it's simple.
Yes.
You just own the raw material.
Yes.
You own the processing equipment, and you do the packaging.
Yes.
So it makes it easy, isn't it?
Yes.
If I'm a milk company and I own 40,000 cows, for example, I could just create more jobs and resolve this. But interesting, let's try to begin to wound down. What's your outlook on the state of the markets and everything based on this monetary policy, holding the rates, and you continue to use monetary policy tools to manage the system until September, technically December? The year is already winding down, technically speaking.
Yeah. Yes. So
once we enter July,
yes,
it's winding down.
So from where we stand right now, considering global and domestic fundamentals, we think that policy rates would be held unchanged. Through the rest of the year. That's basically because of the fact that first is that maturity profile for OMO in Q4 is largely elevated, about 4.1 trillion. Right. Again, some of the new policies that CBN just introduced, especially the one of maintaining 60% loan to deposit ratio, we estimate that could potentially unlock about 1.04 trillion. In liquidity. So obviously the CBN would have to worry about taking out that liquidity. And again, FPI to equities over the past couple of quarters has largely been depressed. Some of the inflows that we are seeing right now are actually much more biased towards the fixed income market. So if you maintain a largely attractive rate, that could potentially leave that space to.
Okay, Mustafa, thank you so much. We need to wrap this up in 60 seconds or less. Kemi, how would you trade this hold rate from tomorrow?
Okay, the CBN governor rightly said that they will keep monitoring the measures they put in place to grow credit, and I think that's one thing we keep, seeing onto the next MPC meeting. Okay,
Robert.
So for the fixed income market, we expect that the current stance on short-term market rates should continue to guide the activities in that space. And for the bonds market, we're beginning to see a situation where yields are beginning to compress, which was the expectation at the beginning of the year. Once the rates are becoming unattractive at the shorter end, then we see some investors playing at the long end of it.
Thank you so much, everyone. Thank you, Robert Tomotone from Afrinvest, Kemi Akinde from Meristem, and Wahab Mustafa from Kodos Capital. Thank you very much for being here. We look forward to seeing you again. And we thank our viewers here in Nigeria and around the world. This has been Channel Television special programming on Monetary Policy Committee Decision Day. We're back to our regular programming at the top of the hour. Bye for now.